So last weekend, I was having a conversation with someone that I hadn't met before, and the question was asked, how much cash is too much? And I thought it was a really good question. So here's some thoughts and maybe some different ways to think about that now. Hi, my name is Eric Blatt with Divvy Wealth Management, and thanks for watching. Before we turn to the topic of the day, I want to share, or at least remind folks that what you're about to hear is not financial advice. This is really for educational or informational purposes only, so keep that in mind. And also, if you enjoy listening to our thoughts on planning and markets and things of that nature, the best way to follow along is to go over to divvywealth.com. That's DIVVI wealth.com. And sign up for our blog there, where we typically send out notes every week or two on things that are happening in the market or things that might be topical for investors and families that are saving for the future. The other way you can follow along is go over to YouTube and search at Divvy Wealth Management and subscribe to our channel there. So with that, let's talk a little bit more about cash. And cash, for the first time really in a long time, it really appears much more attractive these days than it has in quite a while, really for the last year or two. And the reason for that is pretty simple. Interest rates today are as high as they've been in about 15 years. When I say interest rates, I'm talking about specifically the Fed funds target rate, or their range of rates that they target. It's as high as it's been really since 2007, 8, 9 timeframe, somewhere in that ballpark. We've got a chart here that we'll throw up in a few minutes that kind of speaks to that. But savers these days can earn somewhere around 5% on their money pretty darn easily, whether it's high yield savings accounts, money market accounts, and 5% for a lot of folks without taking on really any significant risk can be pretty darn attractive. So the question came up, how much cash is too much? And so I wanted to kind of think about that through a couple different lenses. And the first thing that I would kind of point to is that, I guess before I go there, let me say this. When I'm going to talk about cash here, I'm not talking about physical dollar bills or coins or things of that nature, not money that you have tucked away in your sock drawer. I'm going to use just the 3-month treasury bill as kind of a proxy for cash. There's others out there, but when I talk about cash, it's a short-term, very liquid, very safe vehicle or instrument that is going to pay some sort of interest rate. And so the first thing that I would remind folks when using cash or cash alternatives as an investment is that it's generally been a pretty crummy long-term investment, specifically for U.S. investors. So why is that? The interest rate, the return that people receive from cash type investments is generally going to be considered ordinary income. And ordinary income is typically going to be taxed at the highest rates that you'll pay. So in the United States right now, I'm recording this in early May 2024, the top end of the income tax bracket is 37%. And if you tack on an additional 5 or 6% for state taxes for a lot of folks, maybe an additional 3.8% in the net investment income tax, it can pretty easily get to 50% for many individuals. But whatever the actual rate you pay, I think the general rule of thumb that we point out is that ordinary income tax rates are the highest that you'll typically pay. The comparison there is that long-term capital gains or qualified dividend rates are oftentimes taxed at 15%, sometimes a little bit higher at 20%, and in certain situations maybe as low as 0%. So ordinary income tax, or the income that you would earn from cash types investments, is going to be taxed at a higher rate. So that's the first point. The second reason that cash has generally been a crummy long-term investment, when I say crummy, it's not been a very good way to grow or protect wealth. That's what I'm talking about. And one of the big reasons for that is inflation. So I'm going to share a chart, and the chart here really, it tries to make this point. So the line at the top of this chart, the dark line, basically shows the growth of a dollar since the early 1980s in these cash investments. And again, I'm using just the monthly return for a short-term T-bill to kind of show how that dollar would have grown over the last 45 years or so, somewhere in that ballpark. And a dollar turned into $4.90, which in a lot of cases, for a lot of folks, that may not sound so bad. I'm not going to go make a comparison to stocks or other alternatives right now. Keep in mind, this is a relatively liquid, safe investment. So a dollar turning into almost $5 might seem like a pretty good return. However, a lot of folks, especially if you're owning these types of investments in taxable accounts, are going to have to consider taxes, and you're certainly going to have to consider inflation. So the green line at the bottom of the chart, that just shows exactly how much that value of that dollar in 1981 has eroded due to inflation. So $1, if you could spend $1 in 1981 buying groceries, paying your bills, things of that nature, today that same dollar would basically only pay for about 30% of those same goods and services. So your purchasing power has been severely eroded by inflation over the long run. The orange line here just basically adjusts your total return, that dollar growing into $4.90. What does that look like after inflation? So when you take into account inflation, that dollar has now only grown to $1.46. So again, the majority of your return, 88%, I think is the number that we came up with, 88% of the return that you would have earned by investing in these short-term cash-like instruments would have been eaten up by inflation. And now let's consider taxes. So the brown line, which is second from the bottom, that's going to be an inflation-adjusted after-tax return on cash. And so you can see that original dollar, and let me back up for a second. So everybody's tax rates are different. I just used a flat 30%, so I'm basically assuming somewhere in the 24% range for ordinary income, plus an additional 6% for state. I'm sure that's not exactly what, if you're watching this, your tax rate's probably going to be different than that. But to keep the math relatively straightforward, that's the rate that I use. So the inflation adjusted after-tax return on that cash is now actually negative. That dollar is worth only 91 cents after taxes, after inflation. So when we talk about occasionally, people like different monikers or things that are catchy, and you'll hear from time to time, cash is trash. And if you hear folks say that cash is trash, this is probably the reason that that individual might believe that. The long-term purchasing power of cash has historically been eaten up by inflation, and those problems have been further compounded by folks that have had to pay tax on top of it. So hopefully that makes sense. The second thing that we'll point out is interest rates themselves. Again, we mentioned at the top that rates today are as high as they've been in quite a while. And we're going to show a quick chart here that just shows the Fed funds target rate going back through the 80s, 90s, 2000s, the 2010s, and now the 20s. And you can see how those interest rates have fallen, or had fallen, pretty consistently. There were some ups and downs, but interest rates directionally headed lower for about 40 years before more recently turning higher again. So you can see that, kind of the example that we use is somebody that retired in 1980 might have thought that they could pretty safely earn somewhere around 9, 10, 11% on their money. And if that's the route that they went, if they didn't lock in long-term rates, they were reinvesting those dollars 3, 4, or 5 years later, they were doing so at significantly lower rates. And that trend would have continued through the 90s and 2000s and into the 2010s. So my point with all this is interest rates, we talked about this a couple weeks ago, interest rates, at least in my view, are very, very difficult to predict with any degree of accuracy, especially over the short run. So if you're thinking that cash is a good term investment today because it earns 5% or around 5%, and that seems like a reasonable rate of return, I think folks need to be prepared for the idea, or prepared for a world in which interest rates will likely be different. Whether that's good or bad is difficult to predict, but if that money is really intended to grow and protect wealth for the long run, you're really going to be potentially exposed to changes in interest rates that, for all intents and purposes, are completely out of your control. So just something to keep in mind as we're thinking about cash as an investment as well. Are there good reasons to have plenty of cash at any given point in time? And we think the answer is absolutely. There are plenty of good reasons why somebody might want to have cash. And I think the first and most obvious is really rainy day funds, emergency funds. Generally, we try to talk to folks about having somewhere between 3 to 6 months of emergency savings in some type of a cash account. When I say cash, again, I'm not talking about physical dollars that you keep in a safe or tucked underneath the mattress or anything like that. We're talking about something like a high yield savings account, a money market account, something that's earning interest, but that is also liquid, something that you can get to in a reasonable time frame, so that if there's ever an emergency, rainy days happen, that you can get access to that money for those emergencies. Now, again, that's not specific advice, but those are general guidelines that I think could make sense for a lot of different people out there. So emergency funds would be kind of the first reason. The second reason would be short-term goals. A lot of times we talk to folks about long-term goals deserve long-term investments, short-term goals deserve short-term investments. And there's lots of different reasons why somebody might have a short-term need. And some of the more common ones might include things like they're getting ready to make a big purchase, like a house, and they need to have that cash for a down payment. If you're expecting to buy a house in the next year or 2 or 3, that's money that probably doesn't need to be invested in the stock market. It's just too unpredictable for a lot of people's risk appetite over short-term periods like that. And I know 2 or 3 years might seem like a long time, but there have been plenty of periods in which stocks have fallen 10, 15, 20% over the course of a 2-year period. So if you're really counting on that money to be there, a year, 2 years, 3 years from now, cash can be a great way to save for some of those short-term needs. So we talked about home purchases, maybe you need to buy a car, if there's tuition payments that are coming up for kids in the next year or two, those can all be very, very good reasons. So just think about really the intent. What is that money going to be needed for? And when? More importantly, like when is that money going to be needed? And if it's inside of 5 years, you might want to really consider how much of that you want to put at risk in longer term investments like stocks, because they're just much less predictable over those short-term windows. And the last piece that we didn't write about much is really that idea of optionality. So, I think there is a value to having options, but I think that it's important to kind of have a plan and understand, kind of go into those situations with eyes wide open. It's 2024, it's an election year, so that's a common, I guess, reason folks have for maybe wanting to be patient, waiting to see what happens before putting money in the market or investing in other types of vehicles, whether it be real estate or something else. And again, we would kind of encourage folks to really think about the horizon first. And so if that money is going to have a decade or 2 or 3 to grow, whether you buy it today versus 6 months from now, 12 months from now, it's probably, historically has not been much of an advantage to wait. I mean, I think the more important thing is having those long-term dollars invested in long-term investments so that you can get the most benefit out of compounding. Again, that's not a market call. I'm not suggesting that stocks are going to rise over the next 6 or 12 months, so it's nothing along those lines. It's really more about understanding what you need the money for and when, and helping that guide the decision of how much do we want to have in growth-oriented investments versus something more stable, more liquid like cash. So hopefully that makes sense. I think the final piece of the puzzle for a lot of folks that do have a healthy amount of cash is exactly what to do with it. And we covered this a little bit last year, especially after Silicon Valley Bank failed, and folks were really concerned about the safety of their cash. So here's a few options to consider for folks that do have cash that they want to invest and want to earn a decent rate without sacrificing liquidity or safety. So some of the easiest options are going to be local banks. Many are offering savings accounts, interest-bearing savings accounts, high-yield savings accounts that are offering interest rates, like I mentioned earlier, in the 4.5%, 5%, maybe even a little bit higher than that. Somewhere, 4.5%, 5% is a pretty reasonable rate these days to expect from those types of investments. And they're generally going to be FDIC insured. The only word of caution there is if you have significant amount of cash, just understand the rules. And if the FDIC insurance is important to you, exactly where those limits are and how you might want to consider different options to keep those dollars FDIC insured, if that's important to you. There's also cash management programs that are available that can basically spread money around to different banks on your behalf to keep those dollars FDIC insured and earning attractive interest rates. And then there's others that will just go ahead and invest in treasury bonds or treasury bills. These bonds are securities that are issued by our federal government, so they're generally considered one of the safest, most liquid investments in the world. And with interest rates where they are right now, again, it's fairly reasonable to expect to earn somewhere in the 5% range in a lot of these types of vehicles. Maybe a little bit lower, a little bit higher depending on the day, the week, the month, but somewhere in that neighborhood is pretty reasonable. You can also think about money market mutual funds. And generally, you're going to need to, these are a fund, so you won't have access same day to the money, but in a lot of cases, it's a diversified portfolio of all these different types of investments. They can come in types that are only investing in securities issued by the government. Some may invest in other corporate bonds as well, but again, they're going to try to focus on very high quality instruments so that the value of the fund stays very, very steady. So those are all options that folks consider if they have excess cash. So with that being said, we'll wrap for today. Thanks again for watching. Again, if you'd like to follow along with our thoughts as we post these videos, as we post content, things of that nature, the best way to follow along is head over to our website, divvywealth.com, and sign up for our blog there, or go over to YouTube and search at Divvy Wealth Management to subscribe to our channel. If you have any questions, by all means, feel free to reach out to our team. I would be happy to help if we can. And until next time, thanks again for watching. Bye-bye.